forward it. Oh, Jesus, I just put it to my computer, but oh, well, instead of the cloud. But that's all right. Never going to have too much of this stuff on there. All right, so let's just go through some questions and let's see how you do. This is unit 1, by the way. This is the net capital stuff. So a first-year introducing broker-dealer that does not receive customer securities and aggregate indebtedness of $320,000. Its minimum net capital is.
Okay. So it's a first-year firm. So that means like AI cannot be more than 8-to-1.
You're correct.
It's introducing, so it does not receive customer securities. I believe that's 25,000 is for not receiving the customer securities and introducing, because it's 50,000 if they do receive customer securities.
That's right. That's right. But
So
remember, slow down. It's 25,000 is for a wire order firm selling mutual funds. So this is an introducing broker that doesn't receive customer securities. That's $5,000. Right. So the $5,000 is if I say, David, I'm not accepting your funds and securities for forwarding to the clearing firm. You need to get them there yourself. That's 5. 25 is you're investing in a mutual fund. And I'm going to wire that money to Franklin Templeton and San Mateo. That's 25. If I'm accepting funds and securities, that's 50. So you were right on the 50, but the 25 isn't a general securities broker dealer. The 25 is a mutual fund broker dealer doing wire orders. Okay, so now back to the question. You've told me that you were correct. You told me this is a first-year firm. You said you 8-to-1. And, whether you said 25 or 5, it wouldn't mess you up on this question. Right?
Yeah, because it's 40,000.
There you go. Right. So that wouldn't have impacted your thing there. Right. So there you go. A subordinated loan agreement cannot be prepaid for a period of.
I believe this one is 1 year.
Right on. So you're demonstrating that indeed on the recognition things. Let me just it seems like you're pretty good. Let's see what this. Let's see if we can mix it up a little bit and get you something that isn't. Whoa, what happened there? Okay. Under uniform net capital rule, which of the following requirements must be met for a broker dealer capital contributed under subordinated loan agreement to be treated as if it were equity in the debt to equity relationship?
So one is not true.
The agreement will be treated as it were equity. So again, okay, let's just talk about this. You don't have to count the subordinated loan as debt if it's coming from a principal of the firm. So if this subordinated loan is by a partner, stockholder, or parent company, then we do get to count it as if it were equity because it doesn't count to debt to equity. The assumption would be because you're still going to be a good steward of the capital because it belongs to the same entity. It's under common control. So one is indeed true.
So then it would be answer D.
There you go. Okay. By the way, as a test taker, remember you don't have 2, 3, and 4 anyways, right? So,
well, could you walk me through, because like this is one of them that I do end up struggling with on the exam.
Okay.
So like I know from like the list here that option 2 and option 3 are correct just as facts, but
that's right.
I don't understand why.
Well, it's mandated. One of the thing is that we don't want we're counting it as long-term capital of the firm. And so it puts it in jeopardy if somebody can prepay this thing or it's not a longer term loan because the initial term is 3 years because we're counting it as permanent capital of the firm. So the idea here is to count as permanent capital, it's got to have some minimum length to maturity on the loan because we don't want money coming in and out of the broker dealer right? We don't want this to be like the tide; it washes in and washes out. This should be permanent capital. Remember, that's the same purpose of the no more than 3 temporaries in a 12-month period. Because at that point, they say you should go get a full-blown subordinated loan or permanent capital. If you're running the business at this speed and you're using these temporary subordinated loans more than 3, well, then it's time to think about how to, raise the proper level of capital for the business you're conducting. And then the prepayment remaining term of 12 months is, again, just this idea of we want to make sure that capital is available for some minimum length of time, because again, we are counting it as permanent capital. Now that Roman number 1 is a completely separate thing. What I mean by completely separate, that's just one of those little things. Like you say, well, hey, is your FinOp, is this going to count on that 70% thing? And I said, well, no, I don't have to count it as part of the debt to equity if it's coming from somebody who's involved in the firm. That debt to equity is about my brother, my father-in-law, right? I joke, but Carl Icahn's father-in-law provided the subordinated loan to get his broker-dealer started. And then when he divorced his wife, his father-in-law said that he was actually an owner of the broker-dealer. And, he was a subordinated lender. But the point is that rule applies to his father-in-law. In other words, we're assuming Carl's not going to be as a good steward of his father-in-law's money than he would his own, or a partner of the firm, or, I joked, maybe told you, one of my favorite FinOps over the years has been from Llama Securities, no along with us, but that's Alice Walton's broker-dealer. She was a Smith Barney broker and decided to set up her own firm. And I wouldn't be surprised if the vast majority of the permanent capital of Llama Securities is a loan from Alice Walton. And then if that's a loan from her, that doesn't count as part of our debt to equity of 70%.
So it would be considered equity.
Yeah, just equity,
and not debt.
That's exactly right.
So maybe that's what because I remember back to that question on the exam where it talked about they want to take this subordinated loan, but then it talked about debt and equity, and those terms they're not explained in chapter one. Like in the real world, like where I live here, debt is the liabilities
well, I would imagine, based on what you told me, David, so let's just talk about the real world. That's exactly, I think this year under your belt will help you in a certain regard. But I would imagine, based on our original conversation, that you are doing business with, there's a lot of entities that are under, here comes a big word, common control.
Yep.
Right. And so this loan is coming from within our organization. And we assume, David, that that's not a third party loan, and you're just going to be as good a steward of that money as if it was, your money, because it is basically, right? I mean, it's like, it would be like a subordinated loan from Bank of America to Merrill Lynch. The holding company is making that loan. That's still, permanent capital. Now, again, if now David you're the guy who sent out to go get third party capital as a subordinated loan. In other words, now we're going to be approaching, some entity that is not part of our holding company structure, isn't under common control. Well, then it's most certainly is going to count as that debt to equity. Right. So that's what that is trying to say. And I use the father-in-law example. For example, I financed my firm with subordinated loan from a guy named Bill. So I put up 250 grand and he put up 250 grand. He's not my father-in-law. We have no familiar relationship whatsoever. The assumption is if I was able to put up 250 of Bill's money and none of my own, I'd be a lot more aggressive because, heads I win, tails I win, because I don't have any capital risk. No, I always think of it as the golden goose. If you don't have any ownership in the golden goose, then you're really to fry them up instead of letting them lay the eggs, right? Because the idea when you want to keep the golden goose because it lays golden eggs. But, if somebody doesn't have any skin in the game, they're going to say, hey, I come back and there's my golden goose and you're roasting them on the spit. I go, David, what the hell?
Yeah.
Oh, wow. I love duck orange. I said, well, listen, that wasn't the point. You're thinking short term. So that's where the rules come from. It harkens back to the days when almost all of us were set up as partnerships. So in the old days, brokerage firms were partners, by the way, and we were a little better stewards of capital. We weren't as aggressive in those days because, if we lost the money, it was our own money, right? So, I can't tell you how many partnerships, even in San Francisco, I spent most of my career, we had Robertson Stevens and Montgomery Securities and Hambrick and Quist, and they were all partnerships. And, at some point, the partners say, what are we doing? We're trying to compete with Goldman Sachs, and we're trying to compete with UBS and Morgan Stanley, and they got way more capital than we do. This partnership model just isn't working anymore. By the way, Edward D. Jones is still a partnership, right? So I would imagine if you're a partner at Edward D. Jones and this thing's been a partnership for 100 years, you're going to be a little better steward. May not be true, but that's the point.
Yeah. No, it makes sense. And so then for item 3 listed here, Dean,
Yeah.
what happens? So let's say that you have the subordinated, loan. It's a 4-year loan. 3 years goes by. It's treated as capital. Now we get into it where there's only 12 months left.
Then that's your job as a FinOp to go extend that loan. And say, okay, listen, I can't count it if it doesn't have a remaining term of at least 12 months.
So like if like for some reason it asks about like a subordinated loan that has only 9 months left.
Yeah, then
that would be, then it's debt.
That's exactly right.
Okay.
They also sometimes will ask, do you understand you don't get to count it unless it's approved? Right. So
yeah,
until it's effective, then you get that problem too.
And approval is from FINRA.
Yeah. Yeah. I don't like using the word approve, but effective is the better word. But for all intents and purposes, it means approved. The haircut on a mortgaged-backed security.
Is it B?
Yeah, indeed. I think this is more of a 27 than 28 question, but right. All I would know for haircuts on debt securities, I wouldn't worry about this one. And I wouldn't know the 6%. I would know it's a function of maturity. That I would know. So I wouldn't worry about the percentage here. I would just know it's a function of maturity. It makes sense, by the way, because longer term bonds, longer term maturities have more volatility, right? I think, David, you said you have a bank affiliate, I think.
Correct.
And, I just can't believe the Silicon Valley Bank guys don't understand the interest rate risk in a portfolio of long-term bonds. Now I get it. They were kind of greedy. I mean, they made a conscious decision to not make loans, originate loans, and buy long-term bonds because they pay more. And, that probably would have all worked out if, you didn't have $2 billion that your customers found out you've lost and started asking for all their money back. It might have worked. But, the point is, my friends go, well, you don't feel so sorry for them. And I go, well, not really, because if anybody should understand that kind of stuff, it should be a bank, so.
Yeah.
The sale of a long securities difference. So remember what this means. This means we have more securities than we think. Long means locate, and short would be the opposite of this.
Well, a sale means that you've gotten rid of it. However, it was already counted, because if it was a long securities difference, that means it was already added as an asset. So would it be B?
No, B is a bad answer. So let me tell me, is your tutor.
Okay.
On this exam, never tell me something is going to lower AI or something is to add to net capital. You should always tell me on the test that anything we're asking you about is going to deduct from net capital or increase AI. That's the prejudice of the test. The prejudice of the test is to know we don't add things to net capital. Now, if we're long securities and we sell them, what we think is we're eventually going to find out that we weren't actually long those securities. If we just sit on them, we say, well, geez, here, what a great day. I just have 1,000 shares of IBM. I can't determine who it belongs to. I guess it belongs to me, the firm. I'll sell it. And then we say, well, wait a minute. You're probably going to find out later that belonged to somebody. As a SIPC trustee, I'm going to have to go in the open market and I'm going to have to buy it back to give to the customer. So it's actually going to be deducted from net capital. It doesn't add, because it's, again, from accounting perspective, it's bad, right? If you count your money and you got more money than you think, that's bad. So whether you're under or over, it's an accounting problem. Right? Under would be a short securities difference. A short securities difference would be the same thing, but that's a little more obvious that a short securities difference is a problem. A little less obvious that a long securities difference is also a problem. I usually use the example. I don't know if I used it last time in our talk, David, but I usually joke about how frustrated I was running the bar and restaurant. You know, my clients and I bought this thing, got involved, and I was trying to tell this bartender, when I fired him, he said, well, you're firing me because I'm over in the door. I said, yes, you're over, you're $200 over, right? And you've been under, and that door should balance. Why can't you balance that door? I mean, I should be able to pull that register and it should all add up. And then my friends who were upset with me for getting rid of him. Oh, well, he was over. I said, well, if the drinks are $10, he puts 20 straws somewhere, he knows he's 200 over. And I just happened to yank the drawer before he got, he got the money out of there. Because if he's doing that and he take the 200, it would balance. So I kind of think of that as this long securities difference. It's still a problem. It's a problem because, again, it has to belong to somebody. So if you come to me and I'm seeking guidance, I'm an accountant, and you say, hey, Dean, we're over 1,000 shares of IBM. We have a long securities difference. I say, well, David, just leave it alone. I mean, I don't think we found a free 1,000 shares of IBM. I think later on we're going to discover that belongs to someone. Now, P.S., if we don't do anything, well, we don't have to take a hit. But if we actually sell it, that's when we take the hit, because now we're actually thinking we really did end up in the scheme of things with 1,000 shares of IBM. So what we're doing here is creating kind of a reserve to reflect the idea that that's going to bite us in the butt later on. All right, so we leave it alone. It's not a problem. If we sell it, it's going to be a problem. Now, by the way, as I said, your default. I had a guy, I may have told you this story as well. I'm not an accountant, but I was teaching a 27, 28 class, and somebody asked me a question. And I said, I don't know, accounting isn't as plain as people think. I mean, there's all kinds of interpretation of accounting. I said, but my interpretation of your question would be that this is going to be a deduction to net capital, because that's the default. I mean, that's just, by the way, I could reason my way to that. I mean, I didn't then reason my way why. But one of the guys who's a real accountant went at home at lunch, went to his office. He brought the interpretive release from the SEC. He said, Dean, you were right. I go, yeah, well, thank you very much. But, I kind of knew I was going to be right, because whether you're a bank and it's the FDIC or it's SIPC, nobody wants you to say you got more capital than you got. We want you to be, conservative and say you have less capital. So I'm just saying here that my default position as a test taker would be, I don't want to kiss ass with a test, but I want to be saying things are going to make my business more stressful than it otherwise would be. Those are better answers typically. Then you got to remember too that the test assumes you're working for a sales guy who doesn't understand accounting. Right? So, and the sales guy's going to say, "Ooh, 1,000 shares IBM, let's sell it." So,
Right.
All right. So long securities difference occurs when a broker dealer account of security shows on the stock record. The difference is not sold. There's no effect. And I told you why, because we assume it's going to play out eventually. If the difference is sold, the proceeds are charged to your net worth and thus to net capital, because the idea is you're going to find out you accidentally sold Mr. Jones's securities. A broker dealer that carries customer accounts and makes a market in 8 stocks selling for less than 5 must maintain minimum net capital of.
C.
You say C, and you are incorrect.
Oh, I thought it was a minimum of 100,000 and a maximum of
on
$1
this
million.
test, David, you got an RTFQ. A broker dealer that carries customer accounts.
250,000. Dang it.
Yeah,
Okay.
you got to be careful with that. I mean, listen, as your tutor, I know you know this stuff, and those damn 68s, that could just be a function of RTFQ, man. Remember, you got to rise and meet your highest level of net capital based on your line of business. So this line of business requires 250.
Yeah.
You're correct that this line of business, market making, is 100. But given that you're doing both, you're going to have to rise and meet your higher standard.
Yeah.
A broker dealer is subject to the 25,000 minimum net capital. So I would hope there was some study that you can kind of, as you're doing the question, kind of talk, out loud to yourself. and say, oh, this is one of those broker dealers that does mutual funds by wire. That's what the 25,000 is, right?
Mhm.
Okay, so a broker dealer is subject to a 25,000 minimum net capital requirement. Is engaged solely in the sale of investment company securities. You should have known that by the 25 grand, because that is the minimum. Now remember that is a firm that's allowed to do a wire order. Okay, under which of the following circumstance could this firm accept and execute a customer order to sell shares of ABC?
Would that be D?
Excellent, excellent, excellent. That's a tough one. That was a good one. Good job. A broker dealer is computing net capital 10 business days after the discovery of a short securities difference. The market value of the difference is 160,000. Under SEC rules, the charge to net capital is. I don't think you're gonna have to do this on the 28 because as much as the 27, because 28 assumes you're not actually got inventory, you're not doing the special reserve, that you're using a clearing broker dealer.
They ask it the different way. Like
Yeah,
it's
yeah.
more like the 10 business days and knowing
That's
that it's
right. So we have to charge
25%.
7 business days after discovery. We have to charge 25% of the market value.
So answer is C.
Yeah, yeah. That's I think that's kind of a minutia, right? And then 14 days after discovery, 50%.
Yep.
Under SEC 315.3-1, a broker dealer is prohibited. Now, here's the kind of question you said that you were struggling with about this prepayment kind of stuff. So be careful. So, just again, there is a difference between repaying a subordinate loan that has come to term. That's not what this question is asking. And prepay. That means you're paying it early. So paying it at maturity and paying it at early are different questions, right? So to do this, you're going to need a prior written approval of.
I believe it's A.
Well, the way we say that, you're correct, is we say it's your designating examining authority. That takes both of them in. So A is not necessarily wrong, but it's the same basic idea. The designating examining authority for a subordinate loan is not the SEC, it's FINRA. So, not a bad miss, not a bad miss. Now,
Well, and the reason, Dean, why I always struggle with these is because of the rules that come along with it. Like whenever the
okay,
firm
let's talk about
is
it
in
first. Let's talk about the
yeah.
rules. So you're not going to be allowed to prepay this loan if it would cause your AI to net capital to exceed
120%.
there. That's one. So remember, that's one. So that's correct. So you basically, the way I think of it, I don't know if this is helpful, David. I think to myself, I can't put myself into early warning by prepaying a subordinate loan. That would really be bad form, right? on the hard dollar amount. Okay, so there's another. I also can't prepay if it would cause my AI to net capital exceed
100 or 1,500%. Is
no
that
no
the
no AI to net capital 10.
oh, I'm sorry. Is it 12 to 1 or
No,
is it
it's 10 to
15
1.
to
It's
1?
10 to 1. So that's
10
the
to 1.
weird
Okay.
one about 10 to 1. So we have 8 to 1, 10 to 1, 12 to 1, 15 to 1. That 10 to 1 is about prepayment of a subordinated loan. Prepayment of a subordinated loan. That's where that shows up more often than not. Right? And then you need written approval. An established general securities broker dealer makes a market in 400 stocks over $5 bid and 300 stocks under $5 bid. Their minimum net capital is.
I believe for this one, it's A.
That's right. The floor is 100. The ceiling is $1 million. Excellent. Excellent and very testable. Under the SEC 15.3-1, a broker dealer would be prohibited from taking on a subordinated debt, temporary subordinated debt, if it is given notice under 17A11 within how many days?
A.
It's not 90, it's 30. So that's okay, you know, but a broker dealer would be prohibited. So again, what are you doing? Remember a couple of things here. Should you really be doing a firm commitment underwriting if you've already have a financial distress? Probably
No.
not, right? So, you know, again, it goes back to this again, trying to put it in real world. Salesmen are notorious for saying, I'll sell my way out of it, David. I got this deal coming. We close that deal, where, you know, we'll be fat and happy again. And what this is saying, whoa. You know, we've already got problems that we should be dealing with on the fiscal responsibility front. It would be, again, not prudent of us to be doing firm commitment underwritings where we have additional risk when we already had a 17A11 filing. So that's just by recognition, 30 days, not a bad miss. When calculating a haircut on an open contractual commitment, now that's the, you know, or a firm commitment underwriting. A firm commitment underwriting is called an open contractual commitment. So on the banking side, if I say we have an open contractual commitment with the issuer, and as far as that issuer is concerned, we're going to sell that stock for them. So when calculating the haircut on an open contractual commitment, a firm with computed net capital of $250,000 or more can add back which of the following amounts to net worth.
Is it D?
Excellent. Excellent. So, you know, you're proving your point that you're pretty good on the recognition stuff, right? It sounds like that's, you know, your self-diagnostic is playing out here, that you're pretty good on when it's an aim and shoot, point and click question. I probably jinxed you now, but, you know, that you can handle it. So a broker dealer with a short securities difference must begin to charge its net capital if the difference is not resolved within.
B.
Yeah, you just had that one earlier, so I would have been surprised had that not, you know, got that. After its first year of operation, a broker dealer conducts a wire order business exclusively investment company. So boy, they're kind of being nice here. They're just laying it out that this is a mutual fund wire order firm. So, you know, that's kind of nice of them. And that receives and promptly transmit all, oh, well, that's a hint. All customers' securities and funds must maintain minimum net capital of.
Like these are the ones too, like the point and shoot, where like if for some reason because of the extra like and it makes me have pause, but I believe it's
Yeah,
also
well, you should, because I think I wish I would say you shouldn't, but yeah, you should, because that again is
because
telling us.
receive.
Yeah, it says promptly transmits
Yeah.
all customer securities and funds must maintain a net capital.
Is it 50,000
It says,
or is it?
yeah, well, let's be clear on the reading here. After its first year of operation, a broker dealer that conducts a wire order business exclusively investment company shares and that receives and promptly transmits all customer funds and securities. So here, it's not telling me that we're a general securities broker dealer. It's just telling me that we're promptly going to forward funds. We're going to do wire orders, that's transmit. So this isn't a general securities broker dealer. And I agree the grammar here is a little atrocious. It says customer securities. So, you know, that's a redemption order. So it's not 50, because there's nowhere in this question where it tells us that this is a general securities broker dealer, right?
Gotcha.
And so it must maintain minimum net capital of. 25 grand, and 15 is the fender, 100% is just another way of saying 15 to 1.
Yep.
So that's
Because it's after the first
that's
year.
right. So it's going to be 25 grand. Boom. And again, that was a tough one. I think 50 would have been a good miss, but the other way I would have known that 50 is not the right answer because it says 12 to 1. So that would have been process of elimination if that was the one I was going to do. Right. And then I should have been able to eliminate C because they told us it's after the first year, right? So
Yep.
on its year-end trial balance, how often does a broker-dealer, I'm just asking you a question because I'm poking around your brain housing group, how often do broker-dealers have to do their trial balances?
Annually audited.
Monthly. You got to do your trial balances monthly.
So the trial balance is different than like the part one stuff.
Oh, absolutely. Your trial balance, again, accounting, we have what's called double entry accounting. And so we have debits and credits. And the trial balance should balance is the point. And so that we're going to make you do it monthly. That's a thing you got to do monthly.
Okay.
All right. So on its year end, this is the year end version of this. A broker dealer has a company automobile with a carrying value of 18 grand and a loan balance of 6. Under SEC rules, which of the following statements are true?
This one feels a bit tricky. I would go with B as in boy.
Yeah, you're correct because I would ding you big time if you told me a car is an allowable asset because I call this trick, David, reduction to the ridiculous. If that were true, my CEO would come in with a Ferrari and tell me to count it as part of our allowable assets, right? It just can't possibly be true. So you were correct. It's non-allowable. Now it tells us that we have a loan, and now we got to decide, is this part of aggregate indebtedness? I think this very much fits into the mortgage example, right? So I'm a SIPC trustee. I'm liquidating the broker dealer, and the finance company calls me and says, "Hey, they owe us a balance on the company automobile." I said, "They do." I said, "What do you normally do when people don't pay you?" They said, "Oh, we come repo the car." Well, I said, "I'm looking out the window and it's sitting here. It's waiting on you. I got nothing to do with that." So that's not AI because that's not customer related. Right? In other words, as a SIPC trustee, I don't need to worry about this car. 2 reasons I don't need to worry about the car, because I didn't let you count it as an allowable asset, which means I'm not going to have to sell it to get money for customers. I mean, that's eventually what's going to happen, but I mean, it's not part of the net capital, right? And then it's not AI because it's not customer related. Good job. Good job. That was a tough one. To participate in a firm commitment underwriting as a selling group member, a fully closed broker dealer would be subject to
fully disclosed broker dealer, like that's just custody. So like there's a special category just for firm commitment underwriting.
That's correct. That is correct. And then remember, the other thing is selling. This is one that bugs me a little bit because I never can understand, your point about the real world. This one is one I've never figured out why this is a problem, because selling group members on a separate test question are never liable for unsold securities. So I've never understood why this is a distinction in terms of net capital to be a member of a selling group.
Yeah. I mean, I would guess C.
It's actually the 50 grand guy. Remember, the 50 grand guy can do it.
Okay.
And the 5 grand guy cannot. Right? Neither one of them can manage a firm commitment underwriting.
Yeah.
But you can be a member of the selling group. Now, remember, as a FinOp, as a financial operations principle, your favorite kind of underwritings are best efforts, because there is no liability created in the best efforts underwriting to the broker dealer. And then your other favorite is not to be a member of the syndicate, but rather to be a member of a selling group, because again, selling group members have no liability for unsold securities. A customer has a margin account with a debit balance of 100,000 and market value of 80. A maintenance margin call of 40 has been outstanding for 3 business days. The charge to the firm's net capital, our capital is.
C.
After the second maintenance call, there would be a hit. So on the first one, we don't assume yet, David, that we're going to end up owning $80,000 of this stock. But on the second one, I go, oh, yeah, man, it looks like this guy's going to flake on me. And now I think, okay, well, if this guy doesn't pay, then I'm going to, I'm going to end up owning this stock. And so at that point, I'm going to market to market 80 grand. I'm going to take the haircut, right? Because I think the assumption makes sense, right? The assumption is it's going to belong to us if the customer doesn't pay.
What's the haircut?
It's a normal haircut for whatever it is, unless I give you disclosure, it would just be our 15% haircut, right? So we would take 80 times 15. They probably gave that to us as an answer, would be 8 and 12. Yeah, it would be A. Right.
And then like how we know it's the second one or not the second one is because it's only 3 business days.
Well, it would tell you. It would say the second maintenance call, right? And again, we're unlike the actual test, which is a balance of easy and difficult questions. I'm pulling from a combination 27-28 cubic. And the major distinction between the 27 and the 28, you may not have felt it because of your experience. You may still have PTSD. I'm joking, but that unit 1 net capital in theory and in practice is supposed to be lighter for 28s than it is for 27s.
Sure.
There we go. Here's another one of these prepayment ones. Prepayment. So again, I can't stress this enough. It's a giant reading trust. And what I mean by that is we're not talking about repayment. We're talking about prepayment. And there is a difference between repayment and prepayment. You want to pay it off early. So prepayment of a subordinate agreement is prohibitive if it would cause aggregate indebtedness to exceed net capital.
$10 to 1.
Correct. So that means it's either B or C. You got a 50-50.
And then 120. So B.
Yeah, you're right. So you can't put your anywhere. You got it right. You got it right, right? So all I was going to point out is you should have been able to eliminate C by saying, what?
100.
Yeah, I'm going to put myself in. I tell them I'm in violation because I prepaid my subordinated lender. They're going to be really pissed off.
Yeah.
I always joke. I think I told you that my bill guy, right? When I wanted to prepay him, because if I prepay him, then I don't have a subordinate loan. Remember, he's not a principal stockholder or anything, so it's counting on my debt to equity. And he said, "Why do you want to prepay me?" I said, "I don't want to have to worry about it." Well, that would require me again to make sure I don't, by prepaying Bill, I want to get his money off my balance sheet, cause me to have a go past 10 to 1 or be below 120%, right? And then I got to get FINRA to sign off on it.
And then what would repayment be again?
Repayment was it's reached its maturity.
Okay. And but you can't repay either, right? If it causes you to do something.
Exactly.
Okay.
But you don't need permission from FINRA to repay it if it doesn't cause you to have those problems.
Okay.
All the following are including aggregate indebtedness. I don't know if it's helpful, but I think of aggregate indebtedness. It works most of the time. I think of aggregate indebtedness as what I owe customers and others. What I owe customers and others.
Yeah. And like for this one, I mean, I would just jump on A.
Yeah, because right on. Now, when I say others, it's not all others though. So the only, where the way I think of it lets you down a little bit is others doesn't include banks that have secured, loans with cars or houses, or that's not customer related. And then fail to receive, when I receive from the customer, these ones are always challenging, but a fail to receive means I have a liability, because when I receive that from the customer, I got to give them the cash. So fails to deliver are assets, and fails to receive are liabilities. Good job. Credit balances in customer accounts. Oh my God. If you said A, you should just flunk immediately. Go to jail. Do not pass. Go.
Yeah.
Credit balance and the customers are allowable for net capital purposes. Oh man, that's a major, major miss. Excluded from aggregate debits. My God, if there is anything that's aggregate debits, it's the cash that belongs to your customers. That is the most
So
obvious liability of a broker dealer.
right. This
Allowable
is
asset, it's including AI.
Yeah, D, because it's the free credit balance, right?
Absolutely.
Yeah.
That's right. I always think about when we were doing that accounting in the last session, when we're doing a trial balance, I think that's where, for my small accounting mind, that is the first thing that jumps out to me as being obviously where this trial balance is now talking about liabilities, right? Because I got my trial balance, I got my debits, and I go over here and I see, oh, customer credit. I may struggle with the other ones, but that one's a pretty obvious one. By the way, and as much as that's obvious, this is your point of the test, you'd be surprised how many people get in trouble for this. I mean, remember, this is FTX, SPF guy going to jail. He was using his customers' credit balances to, rename the FTX arena and, buy 8% of Robinhood. All of us in our business, broker dealer and banking business, are going, well, and then he claimed he's a crypto guy. He doesn't know about customer segregation, and, he's offshore, so these rules don't apply to him. I'm like, whatever, But I feel bad because I should know by now to believe in human depravity and original sin, because I bought into this whole mystique. I go, oh, he's a genius young man, and he's arbitrage. I couldn't quite figure it out myself. I go, well, maybe I'm just an idiot. I mean, I understand arbitrage, and I guess maybe those crypto markets are that efficient. When I found out that was going on, I suckered again, right? All the following are counted as part of the equity broker dealer, except, well, here's one Dean would never miss, because this was part of my bane of my existence.
D.
Yeah, that's what your brokers. That's, I didn't mind, David, that it's not the equity, but I thought I should be able to count, not have to take the hit as aggregate indebtedness. But I owe my brokers, because it's not, in my mind, it's not customer related. I told that I'll break down at some point. And I take the hit on that side. Anyways, I was told 5 times that the way I want to do it is not the right way. $25,000 broker dealer, subject to a K1 exemption under 15.3-3, is permitted to
C.
Yeah, we just had that one, right? And that now we know the K1 is talking about a mutual fund broker dealer doing wires. That's what that is, right?
Do they have any check writing privileges?
Well, if it's a money market fund, yes. Is that what you're asking? I'm not sure in the context.
I just remember I remember a question on the exam when I took it, where they talked about who they would make the check out to, and it would be the mutual fund company, right?
In a wire order, this is where the risk is, right? In the old-fashioned model, I say, David, kitchen table, I fill out the mutual fund application. I say, make the $100,000 out to not Franklin Tax-Free Fund, and not the fund. You're going to make the check payable to Franklin Templeton Fund Distributors. And David, what they're going to do is cash it. Load, this is an A share, is 4%. And so that means 96 grand will go into the fund. Now, of the 4,000, the 4% load, that most of that's coming back to my broker dealer. And then I, David, typically get a payout. And so I make my payouts 50%. So I'm going to make a couple $1,000 if you proceed. Now, in a wire order, this is why it's 25 grand. In a wire order, I say, David, don't make that check payable to Franklin Templeton. Make that payable to my broker dealer. Now here's the risk you have, right? Because now the 100 grand is going into my checking account. And I'm just going to then wire it to Franklin Templeton. Now, the problem with that is, let's say it's a $10 million mutual fund ticket. I now have 10 million. I don't know what my number is, but you just made a check payable to my broker dealer for 10 million, and Dean has access to that. So the risk you're taking is that the wire doesn't make it to Franklin Templeton, right? So the wire kind of aggravating, but I was at my bank. I could tell the manager was getting a little frustrated. I wanted to do a wire order, and I guess tellers can't do wire orders anymore. I don't know why. And, the person was telling me I could do this on my own. I said, well, if I wanted to do it on my own, I wouldn't be in this bank right now. I said, and, she could tell I was getting ready to say, just give me all my money. I'll just go find a new bank. I got a pretty good deposit there, and anyways, then they gave me this guy, Nicholas, who's like a, banker. I shouldn't, a term of endearment, baby banker, I'll call him, but it's a term of endearment, not derogatory term. And, I said, listen, Nicholas, I guess it's going to cost me $40. And he says, yeah. And he said, I think, Nicholas, you're worth $40. Do you think you're worth $40? He goes, you couldn't even see where I'm going with it. I said, Nicholas, one of the reasons I want to pay 40, not do it myself, because if this goes south, I'm going to blame you for it. So in my world, that's worth paying you $40. So don't worry about the $40. Dean is blessed enough that I don't worry about it. P.S. But I don't know what kind of balance I need at the bank to get a free wire order.
Right.
I think it should be a courtesy, but who knows, right? A broker dealer engaged exclusively in the sale of mutual funds on a wire order basis. So we've got this a couple times. By the way, I would really have a handle on this, because 28s, the assumption is this might be the kind of broker that indeed a 28 is a FinOp of. The FinOp of this firm is not doing making markets or underwritings or doing all those other kind of things.
Yeah, I mean, our broker dealer just has American funds, BlackRock, some VAs, and 529 plans.
There you go.
So I think
there you go. And
and we haven't made out directly to Capital Group, so it's $5,000.
American Fund's a great fund family, great fund family. In fact, I feel sorry for all these men and women at American Funds. Great reputation, great firm, but they all went and got Series 6s and 26s. And then American Funds has rolled out products that require 7s and supervisors to have 24s. And I always joke, you're really at risk on a 24, particularly if it's been 20 years and you've been selling mutual funds. Needless to say, I get a lot of 24 tutoring business from the American Fund people who have to.
I bet
they're 24.
Yeah.
I feel like starting every 6 class by saying, why don't you get a 7? Because you're going to need it eventually. Okay, a broker dealer is making a market in 50 stocks, selling for more than 5. That broker dealer must maintain a net capital of.
In this instance, because they're not carrying, I don't see the word carrying anywhere.
That's right. That's right.
It'd be 125,000.
Excellent. So again, just proof that on the aim and shoot, point and click stuff as your tutor, pretty good. So I always start with fail to receive or fail to deliver. So this is just Dean again. I'm challenged. So every time I get a fail to receive or fail to deliver, I just take a strategic pause and try and figure out to myself, okay, what is this? A fail to deliver is a liability of an asset of a broker dealer. It's an asset because when I deliver the security, I'm going to get the cash. Aged means I should have had the cash already and I don't. So, I'm failing to deliver. And the reason I'm failing to deliver typically is because the buying broker dealer is failing to receive. They're not paying me my money. So again, the assumption is at some point, if I don't get paid, it belongs to me. Right? Because if I can't deliver and get my money, then I'm going to sell out the other broker dealer. So that's kind of what's going on in this question. I always want to take a strategic pause and say, okay, what is this? Now, aged, remember, means that it should have been settled already, and it's not. That's what aged means. It means that's what the fail is. If there was no settlement, if I would have delivered the security to deliver the money, there would be no fail.
And that's 5 days, right?
That's exactly right. If it's business
so
from settlements,
I thought I sold an asset.
That's right. And I was going to get the cash.
And they haven't sent it back to me for 5 days.
That's right. 5 days after.
I'm going to sell out.
That's correct.
which will
Well, you're on the right
see,
track. You're on the right track. So you're going to sell out. What's going to be the price of the security? By the time you sell them out, what's the assumption you should make? That you're now selling them out and the world is wonderful and you get more money than you originally agreed to sell to that party for? Or
Yeah.
should your default be we're probably going to get less money?
More money.
No, more money would be good.
So
Right.
is it C?
I always told you that when given a choice with an answer set, and you have a choice that says something is going to increase AI or decrease net capital, it should be a 50-50 on which one of those you're going to say. The default of this test is you should never tell me something decreases your financial, responsibility, and you should always default to say it increases. So the assumption is that it's going to be an inventory position and needs to be treated as such, right? Because until you get paid, you still own it, right? And so you're going to mark to market, and you're going to take a haircut. And so if you mark to market, you take a haircut. What is the effect on a haircut to net capital?
Decrease net capital.
Yeah, you should never, like I say, you should never tell me something is either not going to increase AI or decrease net capital, because that's what we torment you with as a test taker. Now, you had the part right. Everything you said was correct up until the end. Fails are aged on the 5th business day after settlement, which means they're marked to market and a haircut is taken. This will result in a charge to net capital unless the mark to market is positive, meaning the stock went up. In this case, there would be no charge. But again, we always default should be bad news. Always default is the bad news. Right?
Increase AI or decrease net capital.
Always is when I'm just telling you, if I was looking at this answer set, even before I read the question, before I even read this question, I'm thinking, okay, it's either going to be this one or this one. I'm never going to say I have to have less than that reserve account. I'm never going to say AI comes out. Now, in the real world, that's true. But again, the test is about bad news. I joke, FinOps are not very popular. And I hope maybe, David, you're a popular FinOp. But, really, we're not popular because we're always telling the banking guys and the trading guys and that we need more net capital, or, we can't do that because we don't have enough net capital. We're not, we're always the bearer of bad news. And the test assumes that, by the way. That may not be true, but the test assumes that. Within any 12-month period, what is the maximum number of temporary subordinated loans that may be entered into from a broker-dealer? This is very, very testable. Everything surrounded temporary subordinated loans is very testable.
Yep. So it's A, 3 of them, because if you need more, you might as well take a real one.
That's exactly right. And remember, you can only use them for firm commitment underwritings. Right. And if we're doing firm commitment underwritings, open contractual commitments, do you remember what the haircut would be for that?
I want to say 30.
Yeah, indeed, 30%. And then this 45 days is testable too. In other words, we better get the deal done within 45 days, because I always think of it, we're putting the firm on steroids. We're doing a puff. We're making ourselves look much bigger than we really are. Now watch out, world, here we come. 27, a market maker carries customer accounts and makes markets in 80 stocks selling under 4. It has a minimum net capital requirement of.
Carries customer accounts.
You got it this time. I'm as your tutor, I'm very happy that this time you didn't stumble out of the gate. You said, this looks like it is a carrying customer accounts, makes a market. And what do you have to rise and meet?
250.
Right on. Good job. A temporary subordinated loan. Now, this isn't prepayment. This is not prepayment of a subordinated loan. This is using a temporary subordinated loan in the context of an underwriting. Well, you know, we just want to make sure we're clear what the context of the question is. Can be taken out.
So, I mean, is that the answer then? Is it D?
Yeah, that's the only purpose you can be using it for, indeed, right?
Okay.
That's it.
See,
I mean,
I didn't know that.
yeah, that's it. So you can't, you know, by the way, this is because the 24s don't know that either. So I say we're in early warning. So I just went about one of those temporary things. I go, well, you must have missed that on your 24. You can't use a temporary loan for anything other than underwriting. You know, I say, hey,
Huh.
you're the FinOp. I'm talking to 24, and I say, listen, our subordinate loan has become deficient. It's with debt to equity 70. It's past the 90th day. You go whip out a temporary. I go, you must have missed that on your 24. I say, hey, we need to get out of early warning. Whip out a temporary. No, the only use of a temporary subordinate loan is to restore net capitals as that takes a hit as a result of firm commitment underwritings. Before its value may be included in a broker dealer's net capital computation, most stock receives a haircut of,
B.
yeah. Let's just talk about these other ones. You told me already what 35% is, right? What's 10%? You remember what 10% is about?
I believe that's preferred
No, that, well, maybe,
stock,
but not what we want you to know. It's about undue concentration.
convertible debt.
No, it's undue concentration. If any
Oh,
one of our securities in inventory exceeds 10% of our tentative net capital, we're going to have to take an additional haircut equal to the original. So 10% is undue concentration. We have an inventory position that exceeds 10% of our tentative capital. Again, this is very low probability, but what about 25? Remember this one?
well, I mean, 25% can be a couple different things. Like it can be like the threshold to determine if there's a concentration of like one stock to like tentative net capital, I
Yeah.
believe.
Well, with the 25% that I'm looking for is if we have long and short inventory, we take 25% of the larger number of our inventory. So for example, I have 800,000 securities inventory long. I have 225 short. 25% of 800 is 200 grand. So 225, I take a haircut on the amount that exceeds on the other side. Very low probability, but you know.
So like, let me make sure I understand both of those. And like the 10%, as you were saying, is if a security equals 10% of what?
Let's just put a number to it. We have tentative net capital of 600 grand. The language is important. Tentative means we have not taken a haircut. So we have tentative net capital of 600. So as a FinOp, I take 10% of 600, 60 grand. I'm going to go now through the inventory. Any position that's more than 60 grand, I'm going to take my original haircut and then on the amount that exceeds. So let's say I'm looking, it's 80 grand. So I go, okay, so I'm going to take 15% on the 80, another 15% on the 20 that exceeds. Now, PS doesn't apply to a treasury. If there's not 1,000 treasuries, then, you know, that's not a problem because that's not a, you know, a haircut problem.
Okay, thank you.
You bet. Subordinated loan must be filed with.
A.
You are correct. Oh no, the original agreement. This is where this is Kaplan being a jerk. You said A. It's the
Yeah.
broker dealers examining it should say authorities, even though it's FINRA, right? So you have to get
Son
a.
of a.
Yeah, I'm with you. That one was. I thought you were right too, just because that was based on our last one. An
Yeah.
introducing firm subject to 50 grand. Now, I always think we should try and project the answer. What I mean by project the answer is say, okay, well, I have 50 grand. What do I know about a 50 grand guy? 50 grand guy can do selling group and a firm commitment underwriting. They can accept customer funds and securities for prompt forwarding. And then I see what is being offered to me as potential answers. And hopefully the answer I'm looking for is on offer.
One and three.
Yeah, you can make an occasional trade. The keyword is occasional for your own account. So the broker
Oh,
dealer is
so it's
allowed to make,
1,
yeah, it's 1, 2, and 4.
4.
Yeah.
So you can manage.
Best efforts. Remember, there's no liability of best efforts underwriting.
I got you. Okay, so
Right.
why can't you do
I'm
the
with
firm
you.
commitment
I'm with
underwriting?
you. I'm with you. I don't know why. Remember, this is the distinction between 50 and 5. There's two distinctions. $5,000 can't accept funds and securities for prompt forwarding. $5,000 guy can't be involved in any firm commitment underwriting any way. 50 can accept funds and securities for prompt forwarding and can participate as a selling group member. And so that would be number 1 and number 2, or excuse me, 4. Best efforts, either 5 and 50 can do best efforts. Because in best efforts, there's an escrow account. I say, David, I'm just going to put the proceeds in an escrow account and we're going to break escrow. When we do it, there's no liability to me on that. Right. So it's
Okay.
1, 2, and 4. The big ones on the test are 1 and 4. All right, there you go. A brokerage firm net capital may not be less than what percentage of net debits?
So this one I also get tripped up on because like 5 and 2 are the numbers that come to my mind
And
with
you're
it.
correct. You're correct about both those numbers.
I think 5 is early warning, and then 2 is the answer to this question.
Excellent. Excellent. Trust your gut. Excellent.
Okay.
Excellent. Broker dealers are expected to be able to demonstrate compliance with 15.3-1. I like this one. This is kind of a trick.
15.3C3-1 is the net capital rule,
Yeah.
which means that they have to do it daily. So that would be B.
Every
Oh gosh.
minute you're in business, you need to be a what? Day to day means tonight could tell me that, you don't have to worry about it till tomorrow. So I don't like this answer set. I like what it's getting at, which is testable. I don't like this particular question, but what they're trying to bait you into saying is we only have to be in compliance when we're doing some kind of report. No.
Yeah.
If I think I'm in violation of that capital, I'm supposed to sit down and compute it.
Yeah. Okay.
See what's going on, right? So. And remember, you can't expand the business. Which of the following credit items are considered aggregate indebtedness? So I kind of gave you the way I think about it, and I said it will, for the most part, work, but
When they say like firm, like they mean the opposite is customer, correct?
that's exactly right. So this is a fail to receive firm. I always take strategic pause. And the reason I take strategic pause is because I always want to kind of, in my own mind, play it through, say, okay, so the fail to receive is a liability because when I receive the customer securities, I have to give them the money. So it is from the firm's perspective, but it's a liability because, again, when I receive the security, I'm going to have to give them the cash. Now it says sold. That means I have not received that security and I've actually sold it, which means I have an accidental short position. And whether it's accidental or not, that's pretty damn dangerous. Now, whether you could get to 1 or not, you should have been able to toss out mortgage, right? You should definitely know the mortgage isn't part of aggregate indebtedness because it's like that car thing we talked about, right? So that goes out. And then short securities differences, you should always know missing securities is a problem. There's no scenario in which missing securities isn't a problem. So short securities difference, stock loan firm. We have lent securities. That's called stock loan. Our securities, not customer securities. We've lent them our securities. And anytime I want, I can tell the customers to give them back. And so it's 1. Now, do you remember how long it is before that short securities difference has to be resolved or we have to buy it in?
That one, if my memory serves, is 30 days.
Good job. Right. Good job.
Okay.
Which of the following balance sheet entries are
Dean, was the
not?
last one?
Yeah.
Dean, was the last one, just to close the loop on that, like that was 1 and 3, correct?
That's right. 1 and 3.
Okay.
I think as your tutor, I think you should have been able to toss out 2 right away. right? So
Yes.
you should be able to toss that out. And then I think you should definitely know that short securities differences are always problems
Yep.
because that's missing
Okay.
security. So I mean, that's a big deal.
Yep.
Which of the following balance sheets are not allowable for net capital purposes?
Every single one of them.
Yeah, I would have been disappointed if you missed that
Yeah.
because you should.
I
I mean,
like those questions.
this is this kind of a layup. It isn't cash. It isn't securities. It doesn't count. So
Yeah.
I mean, I would have been really kind of worried if you missed that, right? An established carrying firm with aggregate indebtedness. So again, I always think of that as what I owe customers and others. So I owe customers and others $1.2 million. I'm maintaining a required deposit of 300,000 in its special reserve. So remember, the whole point of the special reserve is if SIPC shuts me down, they start paying off the customers and they run out of money. What they need to finish paying off customers should be in that special reserve account. And that special reserve account, we can't be, trading the market with that thing. It's got some rules around it, right? So must maintain minimum net capital of.
And so because of those rules, you would actually deduct the 300,000 from the 1.2. And then since they're established, it's 15 to 1. So that'd be 900,000 divided by 15, which would equal 60,000. No. On carrying firm. So it'd be B, 250,000.
Yay, good job. That was perfect, man. And I love it.
Right.
You at the last minute, man. You got, you gotta kind of do your. I'm not teasing, by the way. I tell people that they should need to talk out loud when they're taking the test, and they, give you earphones, and I tease them, but half teasing, half's not. Meaning if you think I'm teasing, I am, and if you think I'm not, I'm not. But I say I like to talk out loud. Say, look at this. And they're gonna say, "Hey, Mr. Tenney, other people are taking the test." I go, "Well, to be honest with you, I don't care about them. Look at this question, man. Almost got me, but didn't get me."
Yeah.
All right, which of the following are excluded? So, boy, now it's asking what does not count as part of what we owe customers and others. What we owe customers and others. You could do this, by the way, you could also do this by going the other direction, saying, what do I definitely know?
Yeah. So we know that aggregate indebtedness would include taxes. So 3 is out.
There you go.
We know that the loans that are secured by company automobiles, it doesn't matter if they're secured by like that type of asset. So that would, I think, be out. So then it would leave 1 and 2, which is not an answer choice. So crap.
Okay.
Like
so
excluded from.
Yeah. Okay. So I'm glad you caught yourself. So now you have to go back. And again, you got to read closely. You're on the right track still. As a test taker, by the way, you did the right thing. You get now what I would probably do is go, okay, what am I sure of? I didn't get the answer I wanted. And so,
Yeah, I mean,
one I wanted, and is there one I'm really strongly convicted on?
I feel like the taxes one, I mean, we owe that to others.
Yeah, but it was so okay. Let's just talk about it. Here's what I would have done. Who cares? But this is how I would have. I would definitely know that if I lose an arbitration case, that means I owe the customer that money. And I would have definitely known that 2 is most certainly a part of aggregate indebtedness. So what I would have done is eliminate 2.
Okay.
Okay, so now I'm eliminating 2. Now my remaining choices are I'm either going to say the loan secured by a company automobile is part of aggregate indebtedness. It most certainly is not, because I tell the bank to come get the car. That is not.
Oh.
Now, the reason 3, David, don't you hate this? Deferred income taxes, not income taxes payable. Deferred. So that's the only thing that makes that not part of it. So, I always say, Kaplans are bastards, trying to stretch your mind, hope it doesn't go back to the same spot. So, but again, as your tutor, I like you were on the right track. But I think what I would have done here, what I would hope as your tutor is that you definitely know this is,
Yes.
and you know that this is not,
Yeah.
right? So,
Those are the types of test questions that just drive me bonkers. Like when
well,
it's,
I'm with you. I get it. I get it. I totally agree
yeah,
with you. But you know,
cool.
that was a tough one.
Yeah.
Oh, now listen, these are the ones, right? Easy balance of difficult and easy questions. I joke for you, angels weep for you. If you miss one of these layups,
It's C.
yeah, you can't be giving those kind of questions up. It's gonna be a long ass day if you get an
Yeah.
amateur. Now, by the way, don't get like the previous one. Don't get to where you go, oh my god, it can't be that easy. They're trying to trick me. You know, you got to be able to squeeze the round down range. A customer has a debit balance of 50 and a market value of 40. Oh my God. So as a FinOp, I'm really concerned. The guy owes us 50 and we only got collateral that backs 40 of it. And it looks less likely all the time that he is not going to pay us. And so it says a margin call for 20 grand was sent 6 business days. And then this was your previous question. The second call. It's given information. So now what are we going to do?
Where does it, a second call. Okay. So now we're going to
It's given information. You
deduct.
asked me earlier, remember? And I said, how do you know that? I said, they'll tell you. So this
Yeah.
is now on the second call. And so what are we going to do?
So the margin, like my thing is like, what do we deduct? So what is the
Well, mark
charge
to
to net
market
capital?
means is we're going to take the haircut on the value, not of 50, but of
Yeah.
40. That's what mark to market means. So it's like learning a foreign language. We're doing a mark to market. So the mark is 40 grand.
Right. And
And so
then the
now,
haircut on.
well, then we're going to take the haircut. So what we're assuming again is that we're going to end up owning the stock.
Right.
So 15%. I get 40 grand.
Like 6,000 is the
Yeah. And it looks like
haircut.
we might have found a typo here. It's 6. I'm getting 6 too, but it says 16. So I'm not sure why it's saying 16. But it's mark to market. We take the haircut.
Well, that doesn't help
Yeah.
when they have a wrong answer.
A broker-dealer's equity cannot be less than what percentage of its debt to
C.
equity? So they're kind of asking this one asked backwards, so to speak.
Yeah. So debt to equity 70-30. So it'd be C.
Yeah, right on. All right, good. I think as your tutor, I'm pretty happy with that. Now, I do feel bad because I think you told me in your previous tutoring sessions you did questions and you didn't like doing questions. So I mean, but
No, I like
we're supposed to
this.
be doing. We forgot to. Doesn't do us any good if we don't actually click the button. So
Yeah, it's A.
yeah, let's see there. And
No, and like to clarify too, Dean, like what I didn't like about the tutoring session before is that she would send me a 100 question test. And then it was paper too. So I would just
so
like
we're
circle it.
talking. We're like a shared screen talking it through.
Yeah. And then I'd get like I'd get like the grade and then there'd be like these like penciled in comments next to
Oh,
it.
it's like you're back in grade school.
Yeah. And as you can see, like there's these, like for me,
Did
like
you
I
do
can
any
remember
Zoom sessions with
facts.
this person or not? Just graded homework or?
We did. And,
Oh,
but again, given grace to her,
okay.
like I
I
wasn't
get
in
it.
the,
I get it. I get it.
but like where